Good day, everyone. Today, we'll be discussing our topic, raising capital. This presentation will explore how businesses, especially startups and small firms, gather the financial resources they need to grow, invest, and succeed in a competitive market. When a business is starting out, one of the biggest challenges is finding money or capital. Startups or small businesses often lack customers, profits, or reputation, making investors hesitant. That's why it's important for entrepreneurs to understand how to raise capital through personal savings, loans, or investors like angel investors and venture capitalists. At the same time, businesses must manage their finances wisely, making sure that every peso is well spent and that investments pay off in the long term. Financial management is simply the process of collecting money for the company at the lowest possible cost and using that money to earn the highest possible profits. To achieve this, companies must choose the right sources of finance, short-term, medium-term, or long-term, depending on their needs. Once the funds are raised, they must be invested smartly. This involves forecasting market trends, evaluating risks, and planning ahead to ensure good returns. And when profits are earned, financial management also includes deciding how to distribute those gains to shareholders as dividends. Fundraising is an ongoing process for most companies. Understanding the different stages of funding can help founders and executives better anticipate the company's needs and make strategic decisions about which sources of investment to pursue. Let's begin with the four main stages of funding. 1. Seed capital. This is the very first funding a business secures. It's typically used for initial research and planning. In other words, seed capital helps turn an idea into a concrete business plan. 2. Startup capital, also known as working capital. This funding supports the early operational costs of a business, such as rent, equipment, and supplies, usually during the first year of operations. 3. Mezzanine or expansion capital. This funding helps the company grow to the next level. It may be used to purchase better equipment, expand operations, or even more into larger facility. It's often called expansion capital for a reason. 4. Bridge capital. As the name implies, bridge capital helps a company transition between two phases of funding. It fills the gap between the current level of financing and the next round, such as a larger equity investment or going public. Each type of funding plays a critical role in supporting the business as it grows and evolves. Now that we understand the types of funding stages, let's explore where this capital can come from. There are two main sources of finance, internal and external. Internal sources include personal savings, retained profits, working capital, and sale of assets. These are the sources that come from within the business or the entrepreneur themselves. External sources, on the other hand, include long-term finance such as loans or equity from investors, medium-term finance such as leasing or venture capital, short-term finance including overdrafts or trade credit, and inorganic growth sources such as mergers and acquisitions. Looking at the diagram, we can see how the sources of funding typically change over time. Early-stage funding often comes from personal savings, friends, and family. As the company matures, angel investors and angel funds step in. Eventually, as the business grows further, venture capital, private equity, and even public markets become potential sources of large-scale financing. Understanding when and where to seek funding is crucial for long-term business success. Choosing the right source at the right time helps support sustainable growth and reduces unnecessary financial risks.
In this section of the PowerPoint, I'll discuss the different sources of finance that companies use to raise capital. We'll look at long-term sources, mid-term sources, short-term sources, inorganic growth strategies, and alternative source of finance. I also highlight the advantages and disadvantages of long-term and short-term sources. Let's start. The first one is long-term source finance. Long-term finance typically refers to the funds that a company raises for investments lasting more than 5 to 8 years. For example, building factories, buying equipment, or major expansion plans. What's the keys that are written in long-term sources is share capital or an equally share, which represents ownership of the company. Um, Next is preference shared. Next is retained earnings. Next is debentures bonds of various types. Next is loans from financials. And next is institution. The advantages in a long-term finance is provides stability and often has a lower cost capital because the repayment schedule is spread out. The disadvantages is it involves long-term commitments and carries risk if market conditions change. Let's proceed next to medium term. Medium term is finance is used for needs lasting around 1 to 5 years, such as upgrading technology to short expansion projects. What's written in this is preference shares, debentures bonds, public deposit, fixed deposit for durations of 3 years, commercial banks, and state financial corporations. These are suitable for companies that need significant funds but not for decades. Let's proceed to short-term finance of short-term finance. Short-term finance is used to day-to-day operations or immediate needs. Some common short-term sources are trade credit, bank loan, bank overdraft, lease, advances received from customer organic growth, and various short-term provisions. Inorganic growth is merge. Oh my god. And the advantages is it's great for emergencies or plugging cash shortfalls in short. It's usually easier to secure and it's often has lower interest rates. The disadvantages is it has immediate impact on cash flow, may require collateral, and is often not sufficient for larger investments. So let's proceed to inorganic growth. Besides traditional financing, what is inorganic growth? Besides traditional financing, companies also grow through inorganic methods like mergers and takeovers, where they acquire or merge with other businesses instead of growing or inorganically. It's like an IPO. As let's proceed, there are alternative source for finance, which are cheat fund, pledging gold, mortgage, asset securitization, and business angles. Projects for a few years. Short-term finance handles immediate cash needs if you're in low cash, and companies can also use mergers, takeovers, or alternative funding sources. Understanding this option helps a company choose the right financing strategy for its needs. Thank you, and let's proceed to the next reporter.
So, what is raising capital for businesses? So, first, you should have proper estimation of total financial requirements. So, the finance manager must accurately estimate fixed and working capital needs, considering factors like technology, workforce, operations, and legal requirements. Next is the proper mobilization. The finance manager must choose balanced, cost-effective sources like shares, debentures, and loans to mobilize funds after estimating needs. Then, after that, is to realize the value of the company. How much is the company worth today? How much could it be worth in the future? Or how long will it take to create the future value? What is the likelihood of achieving success? These are the sample questions that you need to ask yourself in order to realize what the value of the company is. Next is legal responsibilities to potential investors. Business owners must give clear, factual information to investors and seek legal advice when soliciting or contracting funds. And the next one is negotiating a win-win agreement. Raising capital involves negotiating key factors with investors such as amount, timing, return, certainty, and control. Therefore, raising capital is rigorous, requiring persistence and learning from rejection to secure funding for the best ventures. In order to make your company succeed, you have to work hard for it. You need to be persistent in everything that you do and to learn that sometimes not everything may go your way. We must be persistent and helpful in our company in many ways.
Now that we've covered the basics of financial management, let's define financial capital. Financial capital refers to the funds that firms use to invest in projects, operations, and expansion. Businesses need capital for long-term investments like buying machines, building plants, or launching new products. These investments are done today with the hope of earning profits in the future. Firms can raise capital in four main ways. First, from early-stage investors like angel investors and venture capitalists. Second, by reinvesting profits made from the business. Third, by borrowing money from banks or issuing bonds. And fourth, by selling shares of stock to the product. Each method comes with its own set of risks, advantages, and responsibilities. Let's start with early-stage financial capital. New businesses often begin with nothing more than an idea or a prototype. They usually don't have customers or profits yet, so raising money becomes a challenge. After all, how can they attract investors without any proven returns? In many cases, the initial funding comes directly from the owner. This might mean dipping into savings or borrowing money, sometimes even using their home as collateral. Some startups attract angel investors, wealthy individuals who invest in exchange for ownership in the business. Then there are venture capital firms. These firms pool money from institutional investors like banks and pensions and invest it into high-potential startups. They don't just provide funding, they also offer advice and support. Venture capital is risky. Most startups fail, but investors are willing to take those risks because it's a big win, like investing early in Amazon. When a firm earns profits, that is, when its revenues exceed its costs, it can reinvest that money into the business. This often includes buying new equipment, expanding facilities, or funding research and development. For many established companies, reinvesting profits is a major source of financial capital. However, startups, while full of promising opportunities, often lack the profits needed to reinvest. Even large, well-established firms can experience periods, sometimes a year or two, of low profits or even losses. During such times, they may not be able to rely solely on reinvested profits. That's why firms often need alternative and reliable sources of financial capital. Without access to external funding during tough times, even strong firms may struggle to survive. As businesses grow and show consistent revenues, or ideally, profits, they can start borrowing money. Firms with significant revenues or profits can borrow money by promising to pay interest. This opens two main options, banks and bonds. A bank loan works like a personal loan. This firm borrows money and repays it with interest over time. If they default, the bank can go to court and force the sale of company assets. Bonds are another way to borrow. When a firm issues a bond, it's promising to pay back the borrowed amount plus the interest over a set time. For example, a company might issue a $10 million in bonds at 8% interest for 10 years. That's $800,000 in annual interest payments. These bonds can be broken into smaller amounts, say $5,000 per each, so individual investors can buy them. Investors who buy bonds are called bondholders. If the company fails to pay, bondholders can also go to court, but there's no guarantee they'll recover the full amount. Generally, banks are more flexible and are used by smaller firms, while bonds are more common among large, well-known companies. But this isn't a strict rule. Sometimes small firms issue bonds, and sometimes large loans come from groups of banks.
Okay, good morning everyone. And in this part of presentation, I'll explain the corporate, stock, and public forms and a critical concept in business finance. In here, we'll cover what a corporation is, how stock works, how role of shareholders, and initial public for IPOs, dividends are and capital gains, okay? And the difference between public and private companies. By the end, you'll understand how ownerships and decision making in corporations actually work. Okay, let's start. What is a corporation first? A corporation is a business that is legally separate from the people who own it. The owners are called shareholders, have limited liability. Limited liability means that corporation gets into debt or even goes bankrupt. The shareholders don't have to pay company debts using their personal money. Their only risk is losing the amount they invested in the stock. For example, if I buy $1,000 worth of stock in Apple and Apple faces, loses, I don't owe Apple debts. I only risk losing $1,000. This is why corporations are such popular business structures. They protect personal assets of their owners. What is stock and shares? When we say stock, we're talking about ownership in a company. If you own 100% of a business, you own the entire company. This is that. Most large companies divide their stock into millions or even billions of shares. For example, companies like Microsoft, Ford, millions of shareholders around the world. Each shareholders own companies like owns a tiny proportion of the company, but together they all shares holds own the corporation. Interestingly, in big corporations, no single individual usually owns a majority of major shares. Ownership is widely, out among millions of investors. There are key questions about stock. Like, let's read this 1, 2, and 3. Let's read it. And the first one is, how and when does the company get money from selling its stocks? The company only earns money from selling stocks in its own public stock sales. Like the initial public offering, IPO, or when they issue new shares after that. When investor trade shares among themselves, like you buying shares on the stock market, the company doesn't receive that money. Okay? Number 2, what return does the company promise to shareholders? Unlike a loan, stock doesn't guaranteed repayment. Unlike a loan, stock doesn't really guaranteed repayment. Shareholders earn returns either through dividends, which are direct payments from the company's profits, or through capital gains, which happen when the stock price increases and they'll sell their shares at a profit. That's when they get profit, when they sell their shares. Number 3 is, who makes the decisions in a company with thousands of owners? Since no single shareholder actually run the company, can run the company and own it, their whole own it. The shareholders vote for, a board of directors. This board of, direct executives, like the CEO, to manage the business on day-to-day basis. They just hire executives like a CEO. So that's how this company makes decisions in a company with 1,000. So the shareholders doesn't exactly own that. Next is the gateway to public ownership. What is IPOs, the gateway to public? It's one of the most important events for a corporation in the initial public offering, IPO. This is when companies sell stocks to the public for the very first time. The IPO allows early investors like angel investors or these venture capitalists to cash out and transfer their ownership to the public. It also provides the company with a huge amount of capital expansions, like building new factories, entering new markets, or developing new technologies. For example, when Facebook went public in 2012, it's raised over 16 billion in one day. Mark Zuckerberg, rich, which helped it grow into a giant company we know today. Mark, shout out. Dividends and capital gains. What are those? Now, how do we shareholders make money? So there are two main ways, which are written here is dividends. These are regular cash payments from a company's profits to its shareholders. Think of it like a reward for holding, their stock. Example, Coca-Cola paid dividends to its shareholders for a decades now. The next is capital gains. This is when value stock increase. If you buy stock for $50 and later sell it for $80, that $30 profit is a capital gain. However, not all companies pay dividends. For example, like Amazon, often reinvest profits into growth instead of paying shareholders directly. Okay, next is private and public companies. Not all companies are public, you can say that, and not all actually is private as well. So, what is a private company? A private company is owned by a small group of individuals, often the founders and their partners. Example includes Mars, the candy company, or Cargill, which are huge but privately owned. Private companies don't sell their stock on the stock markets. That is a private company. What is a I want to say private? What is public company? Let's see. Public company sells stocks to the public, and anyone can buy or sell shares. Public companies must follow strict reporting rules and be accountable to a shareholders. When a private company goes public through an IPO, it gains massive amounts of capital, but it also, means giving up some control because shareholders now have a say because they buy that massive amounts of capital. So yeah, they have a say now. That's a when a private goes public. Next is who runs the company. Even though a shareholders are the owners, they don't really manage the business. Instead, shareholders vote for a board of directors. The board of hires executives like the CEO, just like I said before, and CFO to run the company. So, the more shares you own, the more voting power you have. But in reality, most small shareholders have little influence because big investors like pension funds for mutual funds or own millions to share and have more voting power. That's how it is in business. More power, more money, more power. What is corporal control challenge? Well, in the board directors is supposed to protect shareholders' interests. In reality, top executives often have a lot of influence deciding who sits on the board. That can lead to conflicts. For example, executives might prioritize short-term profits to increase their bonuses rather than focusing on long-term growth for shareholders. That's why strong governance is crucial to ensure the company is run for the benefit of all its owners. And that's also to recap this. To sum up, corporate stock represents ownership in a company, and company makes money from stock sales and mainly during its IPOs when issuing new shares. Shareholders earn returns through dividends or capital gems. Private companies are owned by a small group, and public companies sell shares to the public. Shareholders elect a board directors which hires executives to manage the company. Understanding how corporate stock and helps us use us how companies grow, how investors profit, and how corporate decisions are made. How decisions are made.
Firms know more about their prospects than investors, making startups risky. Founders show confidence by investing their own money, while angel investors and venture capitalists offer support. Corporate governance often fails, leaving investors without accurate information. One example of this is the Lehman Brothers. It was the major global finance services firm, primarily known as an investment bank, that filed for bankruptcy in September 15, 2008, becoming the largest bankruptcy in US history. This event was a key moment in the 2008 financial crisis. So an overview of this is that it was the fourth largest US investment bank with employees, and it is the fourth largest U.S. investment bank, 25,000 employees and 164 years old. Filed Chapter 11 bankruptcy protection in September 15th, 2008, which is, they became bankrupt, yeah. So let's discuss what happened in the Lehman Brothers company and why it called for bankruptcy. So first of all, corporate governance failures. The board of directors failed to prevent excessive risk taking. Executive compensation committee focused on short-term gains over risk management. The board lacked attention to operations and had limited financial expertise. Next is that the oversight institutions failed. Auditing firms did not provide accurate certification of financial records. Large outside investors like mutual funds and pension funds failed to monitor the activities. Next, the impact of governance failure. Investors lacked accurate financial information about Lehman's operations. It only contributed to the firm's collapse and investor losses. Syempre, you need to have good governance in order for you to keep your investors and to keep up with the economy. Next, lastly, is accessing financial capital options. Borrowing involves scheduled interest payments but retains company control. Issuing stock raises large capital but shares ownership and requires legal compliance. Take note, successful firms may use stock for expansion and reinvest profits or pay dividends. It only depends with the management. And as with the Lehman Brothers, they didn't manage the company well. They weren't risk takers. And in a company, you need to balance the risk management and at the same time keep it safe for both you and the company. And clearly, in the Lehman Brothers, they didn't manage their risks well. Remember, early stage capital comes from personal savings, credit cards, angel investors, or venture capitals. Bonds are financial contracts to repay borrowed amounts with interest over time. Stock represents ownership. Selling stock or the IPO raises capital, but secondary trading does not. Private companies are owned by individuals or partners. Public companies sell shares to investors. Corporate governance oversees executives but may fail at times. Remember to always keep in note what I have said in order for you to have a prosperous investment and to make your company grow into a better one for you and for your employees. That is all for me. Thank you so much for listening, and remember to invest properly and manage your investments properly. Thank you. Bye-bye.